In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about how India is finally rewriting its 75-year-old oil and gas laws to rebuild investor trust and also unlock energy growth. And in the second story of the day, I'll talk about how Asian Paints is being accused of using its market dominance to quietly shut out new rivals like Birla Opus. Welcome to the Daily Brief show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Thursday, the 17th of July. See, India's oil and gas sector is going through one of its biggest shakeups in many decades. And unless you very closely follow this space, you might have actually missed how important this very moment is. See, for over 70 years, India's energy industry was governed by a set of old laws. Some were written as early as 1948 and 1959. Now, these laws were created at a time when India had just become independent and we were still figuring out how to protect our resources in the first place. And back then, the biggest fear was that foreign companies would exploit us once again, just like, let's say, how the British East India Company had done. So our laws give the government complete control over oil and gas. Private companies were locked out, and even when they were finally allowed in, the contracts were fairly restrictive and the pricing was controlled, and sort of the entire system was riddled with red tape, so to speak. But of course, the world did not stay the same and moved on quite a bit from then. The global energy sector evolved, which was shaped by new technologies, climate pressures, and also geopolitical shifts across the entire world. But that said, India really stayed stuck in the past, but only until now. See, this year, India has finally started to rewrite its energy rules right from scratch. First came a brand new law in March 2025, which was sort of a complete overhaul of the earlier legal framework. And then, just about last week, the government released the draft Petroleum and Natural Gas Rules 2025, which are meant to flesh out the details of that new law. Now, together, these mark a very huge shift, because for the first time in our history, we are trying to make our oil and gas industries less about government control and more about private participation, technology, and also trust. The aim is basically to make investing in India's energy sector easier, more stable, and also more attractive. But that said, to understand really how big a deal this is, it helps to actually step back and look at how we got here in the first place. See, when India became independent in 1947, our country's leaders did not really trust private companies, especially foreign ones. And this fear, mind you, was not irrational as such. Colonialism had shown us how easily a foreign company could really take over an entire country's resources. So the first generation of Indian lawmakers really believed that things like oil and gas should remain within the people, which in practice meant the government. And because of that, the state had to act as the guardian of national wealth. Now, this belief also shaped the first major law in this sector, which is the Oil Fields Regulation and Development Act of 1948. This gave the central government sweeping powers over oil exploration and production. And under this very law, in 1949, we created a set of petroleum concession rules which allowed private companies to operate in the oil space through the long-term concessions. But this early system did not really last very long. The rules were vague, private firms had way too much freedom, and oil was far too strategic to be left unchecked. So in 1959, the government brought in a new rule book altogether. This was called the Petroleum and Natural Gas Rules. The rules were tighter this time around. Companies were given only temporary licenses and leases, with the government monitoring their work very closely. So much so that monthly reports were mandatory, and the control was deliberate. India was a newly independent country at that time, and we were still really just building our economy. And oil at that time was seen as a bit of a lifeline. It was way too important for us to leave to free markets. But the problem was that over time, this over-regulation started to hurt the very industry that it was meant to nurture and grow. See, a working oil field requires a mix of things: the right to explore, modern technology, some serious amounts of investment, easy transportation access, confidence in legal protection, and the ability to sell fuel at a fair price. But in India, oil companies were blocked at almost every step. Initially, only public sector companies like ONGC and Oil India were allowed to explore oil. Private companies were not even in the picture at that point in time. And even when they were allowed in after liberalization in the 1990s, their contracts were fairly very complicated, and it was filled with conditions. They required government approval for practically everything, including how much they spent, what tools they used, and even how they priced their output. Additional costs could be audited and rejected as well. And infrastructure infrastructure like pipelines remained controlled by public sector giants, and new projects usually got stuck in approval processes that dragged on for many, many years. And on top of that, the prices of fuel like petrol and diesel were very tightly regulated under something that is called the administered price mechanism. Now, the government here could lower or raise fuel prices to suit political needs, even if global prices could say exactly the opposite of what was obvious here. Now, state-owned companies would get compensated when they lost money, but private players had absolutely no such safety net. And this became especially clear in 2006 when Reliance pointed out how impossible it was to compete fairly in such a setup. They were promised market pricing, but with 95% of fuel stations being run by PSUs who were selling below cost price, private firms had absolutely no chance to run. And this entire mindset had roots in the nationalization wave of the 1970s when the government forcibly took over foreign oil firms like Esso and Bumrah Shell and turned them into public companies like HPCL and BPCL. Now, by the 1980s, the state controlled the entire oil value chain, right from digging it out from the ground to selling it at petrol pumps. But that said, liberalization in the 1990s started to open things up a little bit. We had bidding rounds for private exploration, and later we even let petrol and diesel prices be determined by the market. But again, the system was fairly still messy. Investors were wary, global oil majors stayed away, and even Indian firms like ONGC and Oil India, saddled with outdated methods and equipment, could not keep up with the demand here. And while India's energy needs definitely grew rapidly, our production kept shrinking. And all of this sort of came to a head in 2022 during the Russia-Ukraine situation. See, Russian crude oil suddenly became cheap because most of the world was refusing to buy it. Indian refiners, though, grabbed the opportunity. They bought this discounted oil, they refined it, and ended up making huge amounts of profits. But the thing is, right after that, the government responded with windfall taxes, which is special levies on these excess profits, which were updated every 2 weeks. Now, this pretty much shocked the entire industry. To investors, it sort of looked like India was changing the rules of the game in the middle of a cricket match. The taxes were later scrapped in 2024, but the damage was kind of almost done. The message was fairly very clear. India's energy policies were not predictable. And mind you, it was not just about policy either. It was also showing up very strongly in numbers. I'll explain. See, despite all the noise about energy transition and refining strength, India's refining capacity grew only by 5% in 7 years. And to make things worse, our crude oil production actually fell and dropped more than 14% between 2019 and 2024. And this, mind you, was not just a green transition story. It was also a story of stagnation and a lack of investor trust in the entire country or area, so to speak. And that brings me to the present moment, which is right now. In early 2025, the Parliament has passed a completely reworked version of the Oil Fields Act. And this is more or less like a fresh start altogether. For the very first time, companies would be given a single unified petroleum lease that would let them do everything, right from exploring oil to producing it, under one single permit. Basically, the complicated layers of bureaucracy have been stripped down. Harsh criminal penalties have been removed, and grey areas like offshore rigs and shale oil are formally covered under this new system. And the good thing is that these reforms also opened the door to newer technologies. Companies could now run carbon capture or renewable energy projects under the very same license. Infrastructure could be shared more easily as well, and disputes could be taken into neutral arbitration hubs like Singapore or London instead of being stuck in slower Indian courts. But again, the most important part of the law is a single clause, which is the stabilization clause. Now, this clause is essentially like a promise. It says that once a company gets a petroleum lease, the government cannot change the financial terms in a way that harms the company in any way. And if it does, the company will be compensated. So in other words, the government is basically telling investors that we will not change the rules on you later. Your risks are sort of protected and your profits are your own. Now, mind you, these changes for now apply only to exploration and production and not really refining. But Petroleum Minister Hardeep Puri has claimed that stabilization clause makes it difficult for the government to impose windfall taxes on refining margins in the future as well. Now, of course, whether that claim holds up in the future remains to be seen. But what's also critical to understand is that a law passed by the parliament only sets a broad direction. The finer details, which include how it works in the real world, etc., are really only decided by the rules that follow after that. And that is why the draft Petroleum and Natural Gas Rules 2025 are getting so much attention in some corners of the country. These new rules are meant to bring the law to life. They aim to shift the government's role from being a strict regulator to now being a supportive administrator of sorts. In some areas, of course, they tighten controls, like requiring better environmental safeguards and stricter data sharing norms. But all in all, they bring in more clarity and predictability into this entire game. They define how leases will be given, they set timelines for government approvals, and they explain exactly how the stabilization clause will work in practice. practice. And the timing is also very important. These rules will apply to the upcoming 10th round of oil block auctions under the Open Acreage License Policy, which is OALP Round X. So in other words, the government is essentially telling investors that the 25 blocks we are offering now will be governed by this new and more stable system. But anyway, all that said and done, there are obviously still some concerns. Experts say that draft rules leave some room for the government to modify contracts or even cancel leases if companies do not really align with their broader plans. And that could bring back some of the uncertainty the reforms were actually meant to erase in the first place. But again, to be honest, if you compare this to where we were a few years ago, these are relatively very small risks. Now, for your information, the final rules will be unveiled at a major event called Urja Varta 2025 to be held at Bharat Mandapam. And the government is taking feedback until July 17th. But the real question now is, will this actually work? Will foreign companies start investing again? Will domestic production finally grow? And will India move closer to the energy independence that we have for a very long time hoped to have? It's of course too early to say this for certain, but for the very first time in a very, very long time, it really feels like the system is being rebuilt with some genuine amount of intent. And in a sector where trust is sort of everything, so to speak, that might just be enough to start a very new chapter here. That brings me to the end of the first story of the day. Let's now move on and talk about the second story. See, of course, all of us know that it is not at all easy to build a successful business. And it is especially difficult when your biggest competitor is so dominant that they can very quietly make life harder for you, not really by beating you in the market, but by bending the market itself. That's what Birla Opus, the new paint brand from Aditya Birla Group, believes is happening in India's decorative paints industries. See, earlier this month, the Competition Commission of India, or the CCI, which basically is the government body responsible for making sure companies compete fairly, launched an official investigation against Asian Paints. The allegation was that Asian Paints has been abusing its dominant position to push Birla Opus out of the market. Now the thing is, the idea of a company misusing its dominance to kill a competition is not really new at all. Indian law for a very long time has sort of held that being the biggest player is not a problem by itself, but using that position to harm rivals unfairly definitely is one. Now the latest case could become a big turning point, not just for the paint industry really, but for how regulators really think about competition in our country. So to understand why all of this matters, let's quickly go back to who these companies are and how they even operate in the first place. See, Asian Paints, as all of us might of course know at this point, has been the undisputed king of sorts of India's decorative paints industries for many decades. If you walk into any hardware or paint store in our country and you ask for any color, shade or card, the odds are it will be from Asian Paints. At this point, they have spent many years building relationships with lakhs and lakhs of dealers and painters across our country. In fact, at this point in time, their name is so deeply embedded in the paint buying process that in many parts of India, people actually ask for Asian Paint as a generic term, not really realizing that it is actually a brand name and not really the name of paints. But Birla Opus, on the other hand, is relatively very new in the market. To give you a better sense of it, it's a part of Grasim Industries, which is a flagship company of the Aditya Birla Group. The brand officially launched only as early as February 2024 with the goal of shaking up the 80,000 crore rupee Indian paints market. And in just a very few months, it has already become the third largest player in the decorative paint segment and has captured around 10% of market share. That kind of entry is almost unheard of in any category that has been dominated by deeply entrenched players. But Birlas actually believe that they could have done even better here if Asian Paints had not allegedly blocked their path. They basically claim that Asian Paints has been using its influence over paint dealers to stop them from stocking or supporting Birla Opus. And mind you, they're not the first to say this. A few years ago, a very similar complaint was made by JSW Paints, which is another new entrant in this space. They had launched in 2019 and they faced many of the exact same hurdles. So before we move ahead into the story, let's very quickly rewind to that specific case, because this is what sets the stage for what is happening right now. See, when JSW Paints started selling decorative paints in Karnataka in 2019, they knew that just having a good product could not really be enough. In the paints business, like many other businesses of course, having a strong distribution network is almost just as important. That basically means building relationships with local paint dealers who act as the intermediaries between manufacturers and end consumers. And to give you a sense, these dealers are more like Kirana storekeepers in the FMCG world. They decide which brands get shelf space and which ones get ignored. So naturally speaking, if you want to grow this business, you need them on your side. And JSW Paints did exactly what any new brand would intuitively do. They approached dealers across the country, they offered attractive margins, promised promised support and also asked them to stock JSW Paints alongside other brands. But according to JSW, the moment these dealers agreed, Asian Paints stepped in and pressured them to back out. Dealers were allegedly warned that if they continued doing business with JSW, they would face consequences, which means that discounts would be cut, deliveries would be delayed, or even stopped altogether. Now, the thing is, in India, a company that holds a dominant position in any industry is expected to act responsibly over here. And if that company uses its dominance to restrict competitors from entering or surviving in the market, it can be hauled up for abusing that position. So JSW filed a complaint with the CCI, and another dealer, which is Balaji Traders, also joined in with a very similar allegation. So the CCI took the claim seriously and they ordered a detailed investigation by its Director General. The investigation admitted that Asian Paints was clearly dominant. That was not up for debate at all. Their share of market, dealer network, and brand power was sort of unmatched and unheard of. The question was, did they really use that dominance to unfairly kill off JSW? Now, JSW claims that they had identified over 1,300 dealers who were pressurized into backing out of agreements, but only a handful were actually willing to go on record, and many did not even have concrete proof. In fact, some even later gave statements supporting Asian Paints. There were other complaints as well, like lease interference and downgrading dealer status, but each and every time, Asian Paints managed to provide a business explanation to it. Whether it was to do with invoices, payment timelines, contract expiries, etc., their paperwork seemed to be all in order. So the CCI, after a very long investigation, concluded that there was not enough hard evidence to prove that they were specifically targeting JSW to keep them out. In fact, during that same period, JSW had added more dealers than Asian Paints had. So the logic was fairly simple. If JSW was being blocked, how was it able to grow its dealer base so quickly? Now, of course, that's a very questionable assumption because there were so many business tactics involved. Because JSW was starting from zero, so even the modest additions would actually show up as very high growth. And in fact, many of the dealers they added may not have been the high volume ones that Asian Paints had controlled. But again, those nuances were not enough to shift the outcome. So in the end, the CCI gave Asian Paints a clean sheet, though it left the door open for fresh evidence in the future. And that brings me to Birla Opus right now. See, in many ways, they have taken notes from JSW's experience, but this time they have actually tried to build a slightly stronger case. They have commissioned independent market surveys to gather some extra evidence. They have collected testimony from dealers, and they have also put together a bit of a detailed allegation on how Asian Paints is allegedly misusing its power. The complaint from Birla Opus claims that Asian Paints is actively discouraging dealers from working with them, not just through casual conversation, but through very specific actions. This includes reducing discounts, like I said, cutting credit limits, cancelling loyalty rewards, and even threatening to end dealership agreements. One big area of concern that they point out is tinting machines. Now, these are critical tools that allow dealers to mix and match paint colors on demand. And in the paint sector, whoever controls the tinting machine essentially controls the shelf. Birla Opus claims that they have designed a better and more modern machine, which is smaller, internet connected, and is tablet operated. But many dealers who actually accepted these machines allegedly faced pressure from Asian Paints to return them back, and some even had to do it citing threats to their existing business. Now, Birla says that this is anti-competitive for two reasons. First, it prevents a better product from reaching the market, and second, it locks dealers into a single brand without any formal agreement, just by quiet pressure. So going ahead on JSW's playbook, Birla has submitted a list of 100 such dealers. This is a much stronger starting point for sure, and the CCI has already acknowledged that Asian Paints continues to dominate the market and has enough power to bend dealer behavior. And based on the early evidence submitted, they have now ordered a fresh investigation into whether Asian Paints has crossed the line. Now, let me tell you that at this stage, it is definitely not a guilty verdict. It is just a small signal that the complaint is serious enough to investigate in the first place. But again, this time, like I said, Asian Paints might find it slightly harder to argue that everything was just business as usual, because the more dominant you are, the higher the bar is for your behavior, and of course, the more other people who are eyeing your business and your stake in the market. And if the biggest player in the market is found to be using its power to block out rivals, even without written contracts for that matter, it could very heavily change how competition law is enforced in our country. So the question in the end is very simple. Is Asian Paints actually innocent and is sort of being cornered by newer players? And can they defend itself with the same argument once again? Or will the Birlas be the ones to finally tip the balance here? The question, of course, remains unanswered, and none of us can really make any formal judgments, but this is what the case is right now. That brings me to the end of the two stories of the day. On that note, let's move on to the final section of the day and talk about the quick news headlines. First, earlier this week, we had said that China's chip dreams have been running into hurdles, including inefficient technology, patchy supply chains, and a leaky big fund. But this week, there's actually a surprising vote of confidence from the other side. Nvidia CEO called Chinese AI models world class, specially naming DeepSeek, Alibaba, and Tencent. This came at a Beijing Supply Chain Expo just a day after the US greenlit sales of Nvidia's downgraded H20 chips to China. He said, and I quote, "It's crucial for American companies to establish roots in China." On the show, we've looked at TRAI's pricing cap on public Wi-Fi and how it was designed to unlock digital access. But now, TRAI's pricing playbook is back in the news, and this time it is in space. The Department of Telecommunications looks set to approve TRAI's controversial SATCOM spectrum pricing despite protests from telecom operators. The regulator wants satellite internet providers like Starlink, OneWeb, and Geo Satellite to pay a modest 4% of their adjusted gross revenue with absolutely no upfront spectrum option. Telcos say that it creates an uneven playing field as they pay far higher levies, which is up to 21%, and bid billions for spectrum. But TRAI insists that satellite spectrum is a shared resource globally, not something to be auctioned. Third, on multiple occasions on this show, we've looked at the complex and fascinating pharmaceuticals industry, and there is a big update on that sector now. Anthem Biosciences' $395 million IPO was fully subscribed on its second day, reflecting strong investor confidence in India's pharmaceutical sector. The company, which is based in Bangalore, specializes in early-stage drug discovery, and it is well positioned as global pharma firms seek alternatives to Chinese suppliers. Fourth and the final one for the day, beyond the daily brief, we also have a show called Who Said What. In one of those episodes, we had looked at what experts were saying were the problems with GST. Now, luckily, there seems to be a bright spot over there. The Prime Minister's office has approved a significant overhaul of India's GST framework. This marks the first major change since its implementation about 8 years ago. The promised reforms aim to streamline the tax structure by reducing the number of slabs and also simplifying procedures, with the key recommendation being the elimination of the 12% slab, potentially moving items to the 5 or 18% categories. That's all the news and stories I have for you today. I hope you enjoyed this episode. This is your host Anurag Bansal signing off. Take care and I'll see you tomorrow. Bye-bye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.